Thanks, Tom, and good afternoon, everybody. My presentation today, I'm going to look at the residential and commercial property markets from a demand-supply perspective. So we're looking at the quantum of property that's required for both residential and commercial property transactions every year, what's available and how that is affecting both price and rental performance in the different sectors. I'm going to look at it across the country overall, so looking at gross demand for residential accommodation in the country overall, how supply varies on a county-by-county basis, and therefore how price is going to perform currently and into the future in terms of house prices, and then looking specifically at the investment property market for commercial, looking at volumes of activity that have taken place historically, how current activity compares to that, and where we see the market going in the future. So to begin with, first of all, we're losing a bit of the slide, but we'll bear with it. In terms of the residential property market, we've obviously come out of what was one of the worst recessions in terms of commercial or residential property in the developed world. We're now moving into a period of recovery and into growth, but it has come from quite a low base. So we look at activity levels last year, about 42,000 residential properties transacted in Ireland last year. This represents 2.2% of the housing stock. Now, it is a very significant uplift from where we were in 2011. There was about 18,000 transactions. So we have come from quite a low base, but relative to a normal functioning housing market, really the Irish economy is still in recovery mode, and it certainly is nothing close to a booming market. If you look at the different counties there around Ireland, the colour on the map is significant. A red colour suggests a market where you've got reasonably strong levels of activity. A blue suggests a market which still is in either recovery or certainly experiencing quite a low level of activity. So really, it's Dublin, the Mid East and the other urban centres where we're seeing recovery. And there is pockets of the country, certainly in the northwest and heading down towards the southeast, where activity still remains quite poor by a normal standard. But even looking at the locations where the market is recovering quite well, it has not quite reached what we would consider to be an international acceptable level of activity, which would be somewhere between 3 and 3.5% of the housing market. So we would expect to see further growth in terms of transaction activities in the coming years as Ireland really stabilises and moves into recovery. Just looking at demand, and our slide has jumped a wee bit there, in terms of the profile of demand, very significant quantums of activity is taking place in the owner-occupier side. So about 3/4 of all the market transactions in the past 12 months, indeed into the opening 3 months of this year, were owner-occupiers buying houses in which to live in. Investor activity remains relatively subdued, particularly when you're given where we are in terms of the recovery phase. So we're seeing about 1 in 5 of the purchasers in Ireland and only 12% in Dublin are investors buying buy-to-let properties for the rental sector. Now, given a rental crisis, which we're very much clear is taking place at the moment, this is a very low level of activity overall. In terms of housing need, the population of Ireland grew by about 8% between 2006 and 2011. And really, if you take that from an international perspective, where we had such a very, very significant economic recession, for there to be population growth in the order of 8% was really quite phenomenal. And that population growth has continued and will continue given our demographic profile over the next number of years. So we're looking at the population growing to about 5 million by 2026, which requires building construction activity of about 30,000 houses per annum, commencing at about 20 and growing to over 30, but averaging to about 30,000 houses per annum in the entire country, of which about 1/3 of those need to be in Dublin. And if you take the greater Dublin area to be in Dublin, Kildare, Wicklow and Meath, we need to be building in the order of about 15,000 units per annum, both houses and apartments, to meet the need of a growing population. So that's basic household formation needs. In contrast to that need for housing, we're supplying significantly less than that. I think I may have lost a slide, but anyways, we're building about 11,000 units last year, may increase to about 13 or 14,000 this year, but still significantly less than the market requirement. And looking at what is available on the market to buy now, I think one of the other speakers earlier on, Brendan McDonough, may have mentioned that at some point in 2009, somebody came out and said there were 300,000 vacant units in Ireland, therefore we never need to build another house again. That certainly wasn't true then, and certainly is not true now. So what we do every 6 months in Fitzgerald is we look at what's available for sale on the market in every county in Ireland, and that's publicly available information. We download it from Daft and My Home, and we look at the quantum in each county as a percentage of the stock of private houses in each county. So just starting there at the beginning of this year, there were just over 30,000 units advertised for sale in the country overall, which represented 1.6% of the private housing market. And again, if you think about what a normal functioning housing market would require, you certainly would need 1 year's housing stock and ideally up to 2 years' housing stock for the market to be functioning properly. So if you're transacting about 3% of a year, you need 6% of the housing market to be available for sale, and that prevents spikes or drops in terms of prices. That would be a normal functioning housing market. So for the first time since the recession began, as we opened in 2015, there were about 30,000 properties available for sale, where we had transacted over 40,000 the previous year. So for the first time in this recovery mode, we had less housing stock actually advertised for sale in the country overall than had been sold in the previous 12 months. So that to me was a significant milestone that the market had moved towards. And if you look at the areas in the map, again, the colour is important. If you look at Dublin and the Mid-East, Cork City and Galway City, in all of those locations we're seeing the stock of property available for sale less than 1% or just marginally greater than 1%. In Dublin, overall, it's 0.8%. In Cork City, it's 0.9%, Galway City, 0.8%. So that would suggest all of those locations are suffering from a critically low quantum of properties advertised for sale. And the combination of growth in urban population, rising demand for accommodation, and a particularly tight stock of available property has put to date very significant upward pressure on prices and should continue to do so in those locations over time. In terms of who is selling the property, and this is important in particular in relation to the buy-to-let sector, if we look at our transactions, and this is just based on Sherry Fitzgerald transactions in the opening quarter of this year, our market share would be about 10% of the country overall, so it should be a good indicator of the entire market. 36% of the units we sold this year, and it was almost identical to the entire proportion for last year, were people voluntarily selling their buy-to-let investment properties because of financial constraints, I can only imagine. And a further 16% of our sales were bank repossessions, which were typically buy-to-let properties. So combining those two sectors together, over half of the properties that we sold this year, and indeed over the course of last year, were people divesting themselves of their buy-to-let properties. And yet, if you think back to the purchaser profile, only 1 in 5 purchasers are investors. So what we're seeing is a very significant depletion in the available rental stock in the country overall. So it's not surprising that we're seeing very significant rental inflation as a result of this. And that certainly feeds into the whole supply side conundrum where we are now. We've had a very significant recession. We haven't been building very many properties, but equally we haven't been investing in the buy-to-let sector. So not surprisingly, we're experiencing a period of high price inflation, but also a period of significantly high rental inflation, which I think is going to be a big challenge for Ireland in the coming months and years. Just in terms of that price performance, what we've seen is we have lost a slide here, but I'll fill you in on what it said. Since the recovery began, typically Irish house prices have recovered from a base, from the bottom of the market in 2012 to today by a little over 20%. The Dublin market is up about 30%. What we've seen is that the Dublin market recovered first in 2012 and really experienced quite strong levels of price inflation initially. Now that has moderated, particularly in this year and certainly in the latter months of last year, as Dublin a lot of the excess demand that was there at the beginning of the recovery is mopped up. So we're seeing a cooler Dublin market, but where the recovery began in Dublin, it's now spreading throughout the entire country. So over the course of the first quarter of this year, what we saw was the Dublin market in terms of capital appreciation grew by about 0.9%. Now in the first quarter of last year it was growing by about 6.5%, so a much more moderate level of price inflation in Dublin. But outside of Dublin, quite strong price inflation, about 2.8% on average. And the two key locations which are performing particularly well at the moment are the Mid-East, which grew by over 3%, and the South West, which is really the Cork market, fueling very strong growth there at about 3.2%. The West, which has been led by Galway, is growing by about 2.2%. The border region is sluggish there, still at around 1%, led by periphery counties. And we are seeing a recovery both in the Midlands and in the South East. So whereas 12 months ago we were talking about this as a Dublin-led recovery, Dublin-led price growth, we're now seeing a greater level of price inflation throughout the entire country. Now it has to be said, it is coming from quite a low base, but the recovery is spreading throughout the entire country, which is positive for Ireland Inc. And in terms of a heat map for recovery, where do we think will be the areas that benefit most from recovery in house prices and which areas will lag behind? We expect to see that Dublin and the Mid-East in particular will recover quite well and continue to appreciate in value over the next number of years, as will the other regional centres of Dublin, Cork and Galway. But there will still be problems in the border regions, in the northwest, and moving down towards the southeast, where we're seeing local economic conditions where supply of available property remains slightly elevated, where unemployment levels may be higher than the average, and where the potential for greater growth in demand is somewhat limited because of local economic conditions. In other words, all areas are recovering, but some sections of the country, particularly the regional centres, will benefit most from this recovery in terms of capital appreciation. So we've moved from a very significant recession in the residential market into a recovery mode, but there are still challenges. We don't have enough stock available, which is putting upward pressures on prices, and the ability for that tap to be turned on quickly for a variety of reasons which have all been discussed by the previous speakers is somewhat limited. So we're likely to see a period of greater capital appreciation and greater rental inflation in the short term rather than a more stable recovery, which would be ideal. Now, turning on to the commercial sector, obviously the residential market has been much discussed. We all know about the residential property recession, but similarly the commercial market was very significantly impacted, albeit it was a little bit later in terms of the crash. It was really 2008 before we saw a significant downturn in commercial property. Thankfully, that too has largely come to an end, and we're seeing a period of rental inflation, particularly for prime property, and very significant investment in the marketplace. And there's a lot of discussion about how much money is flowing into Ireland. Typically, in the past, we looked at a very singular level. We looked at the value of investment in the marketplace greater than €1 million, and it typically was really a Dublin-Cork phenomenon. Because of greater availability of data now, it's not perfect, but it's getting better, we're able to take a more global picture, a more national picture of the property market. So the next couple of slides are looking at absolute transaction levels, both in terms of residential and commercial activity throughout each county in Ireland, and then looking at combining that. So the first one here looks at the residential sector. So we're looking at how much, looks at the commercial sector, I've lost the top of the slide, how much commercial investment took place in each county in Ireland over the past 12 months. So it comes in at just under €4.5 billion worth of commercial investment. About €4.5 billion of that was pure, greater than €1 million transactional investment activity. And then we added on top of that agricultural land sales, development land sales, smaller assets that transacted in each of the counties. So you can see there's a very significant dominance of Dublin there, just over €4.2 billion worth of commercial investment in Dublin. The next strongest location is Cork, but is significantly smaller, just over €300 million worth of commercial investment activity in Cork. And then a scattering throughout the entire country. And Galway and Limerick would have less than €100 million worth of commercial transactions. So really, in terms of a commercial recovery, it's been very much to date a Dublin recovery, with a little bit of an improvement in the other regional centres, but they significantly lag behind Dublin and indeed Leinster overall. And then looking at the residential sector, if you download total activity in the residential sector according to the Property Price Register, there's a little over almost €9.5 billion worth of residential activity. About €8.5 billion of that is pure singular residential, people buying houses to live in or to invest in, and about €1 billion of it is multifamily activity, bringing the total level of investment in the residential sector last year to just under €9.5 billion. So in total, about €15 billion worth of commercial and residential property transacted over the course of the last 12 months, which is a huge uplift on what we would have seen over the course of the recession, and typically much stronger than most people would have imagined occurring at this stage. And obviously on top of that, we'd a further €17 billion worth of loan sales. So Ireland is really very popular in terms of international investor activity, and it's benefiting probably the Leinster area most. Now, if we look just specifically at where we have good historical information, and I'm hoping, we seem to have lost a couple of slides, but the previous slide would have shown you investor activity in terms of volumes over pure investment activity in volumes over the last 20 years. And what it would have shown you was that typically about €1 billion worth of investor money floated into Ireland every year. There's been a couple of anomalies. Last year, €4.5 billion, which was significantly ahead of the previous high, which had come in at about €3 billion. So really the focus of investor activity in Ireland is pretty strong at the moment. And most of that money is flowing into Leinster area and into the office market in particular. And the reason for that has been mentioned earlier. We're seeing fairly significant uplift in labour market requirements for office accommodation, but it is a more refined request. People are looking for prime grade A accommodation in all of our regional centres. And this is almost impossible to see because we've lost the actual chart, but if you were able to see it, you can see that the vacancy rates in all of the regional centres have come down, but they still remain somewhat elevated in Limerick and in Cork in particular, where they're averaging over 18%. The vacancy rate for office accommodation in Galway is now sub 10% at 7.5%, and in Dublin has fallen from a peak of almost 30 down to 13.5%. But if you look at prime grade A accommodation, the CBD, the vacancy rate is now sub 4%, which is really leading to very significant rental inflation in the office sector. And the reason for that, really, you can see over the course of the recession, while gross take-up levels in the office market remained quite strong, net take-up, which is really the change in occupied space, actually contracted. So we saw a lot of churn in the marketplace during the recession, where people moved from the suburban accommodation into the city centre, typically to avail of cheaper rents, better accommodation, because rents had fallen. We're now seeing a period where we have gross and net take-up levels in very positive territory, and the gap between the two have narrowed and vacancy rates have come down. And that has led to increasing demand for accommodation in what we call the CBD, which is outlined in this map here. So almost half of all the space taken up in the office market last year was in the central business district, and a very significant proportion of that was for Grade A accommodation, which has led to a very significant reduction in the available quantity of Grade A accommodation. So if you look at this chart here, we have net availability in CBD every year of Grade A accommodation and that year's take-up levels. So for the first time in 2014, we saw less space available at the end of the year than had been taken up in the previous 12 months. So not surprisingly, there was a rush to acquire that accommodation over the course of 2014, and as a result, prime office rents grew by 49% over the course of 2014. And this is what's leading to obviously very significant investment in the sector. That's a huge level of rental inflation. So in that 12-month period, rents grew by 49% to just over 520 euros per square metre for office accommodation. Now, do we see that continuing into the future? To a degree, but at a lesser pace. If you look, again, this chart is, we've lost the chart, but if you were able to see it, you can see there are only 2 buildings left in Dublin now, which is greater than 5,000 square metres in size, which really means that the pressure is there for development activity to commence. And the quicker that development activity delivers stock, the quicker we can get that rental inflation under control. Our sense, if you could have seen that graph, was that that stock is remaining quite depleted, and we're not going to see supply meeting demand in the next 2 years or so. So rental inflation will continue quite strongly. The previous high in terms of square metres, rents per square metre, got to about 620 euros per square metre of space. I think we will approach, maybe exceed that for a short period of time, but over the next 5 years we expect to see rents growing from their current level of 530 euros per square metre to exceed 600, but more than likely as we get towards 2020 to come back to average at about, because remember we have upwards and downwards rents reviews now, to see rents levelling out at about 600 euros per square metre. It is higher than ideal, but does still place us, if you look at our competitors, if you can see the chart, the main cities that we compete with, we would still be pretty much in a competitive position. Any inflation beyond 600 is not ideal and certainly would have a negative impact on our FDI investment in our economy. The biggest challenge, however, for the commercial sector, I think, will be delivering that space as quickly as possible to prevent excessive rental inflation in the short term, so that we can remain a competitive nation, that we could continue to benefit from strong FDI investment, which has been a very significant factor in the recovery of the commercial property market. So I want to apologise for the loss of the slides. We will have them available if anybody wants to have a look at them in greater detail later. Thank you very much.